There are 4 ways that closing your credit card could hurt your credit, and one way that it could help. If you close a credit card that you currently are not using, you will lose the open line amount on that credit card. Say you have 3 credit cards and you're only using one of them on a day-to-day basis. Let's say they each have a $1,000 credit limit, but your average balance on the one that you do use is $900. Your overall credit utilization is $900 divided by the total credit limit of the 3 cards, or $3,000. Your credit utilization is 30%. If you close the one of the cards that you don't use, the new utilization is $900 divided by $2,000. Your utilization goes up to 45%, and you haven't changed any of your spending behavior. When we studied millions of credit files, we found that there is a relationship between utilization and credit score. If your utilization goes up, your credit score will go down, and vice versa. If your utilization goes up 10%, your credit score will likely drop between 8 and 15 points. This relationship holds whether your utilization starts at 80% or 20%. The second way that closing a credit card could hurt your credit score is it could drop your average age of credit. If you have 2 credit cards, one that you've had for 10 years and the other that you've had for only 2 years, your average age of credit is 6 years. But if you cancel your 10-year-old card, your new average age of credit drops to 2 years. Now, it's pretty common for people to eventually want to get rid of their oldest card. It might have been the only one that they could qualify for years ago, but now they have better options and no longer use or want that older card. The point of a credit score is to help people know how you handle credit. When you have a long age of credit, it shows consistency. Canceling a credit card could drop your average age of credit. This is a very limited factor though, so it's really not a good reason in and of itself to keep the credit card open. The third way that closing a credit card could hurt your credit score is if doing so eliminates a type of credit. Again, the idea of a credit score is to predict how you will handle credit in the future. If you have several different kinds of credit, like a mortgage, a car note, and a credit card, it shows you can handle different types of credit. If you eliminate one of those forms of credit, your credit score could go down. That's why some people will actually see their credit scores go down a bit after they pay off a personal loan or a mortgage. If you have 2 credit cards and you close one, you still have revolving line of credit with the other one. So in that case, it probably wouldn't impact you. It's also a fairly minor impact, so it shouldn't be the deciding factor on whether you keep a card open. The fourth way that closing a credit card can hurt your credit score is because a closed card no longer reports on-time payments. When you make your credit card payments on time, the credit card company reports an on-time payment to the credit bureaus. On-time payments are the single most important factor in building a strong credit score. So if you've been making on-time payments to that card, it could have been helping you grow or maintain a strong credit score. The way in which closing a credit card can actually help your credit is if closing it is best for your overall finances. If you find that you overspend using a credit card, or carry a large balance on the card, or make late payments on the card, having that card isn't helping you. Closing it and simplifying your financial life could make everything easier. That could ripple out into your other finances and ultimately improve your credit score. But keep in mind, we don't live our lives in service of creating a credit score. Building and maintaining a strong credit score should be a tool to help us live the life we want. Most of the negative effects of closing a credit card won't actually last very long. So don't hold cards that you don't want for a long time, especially if they have annual fees. Now, if you need a strong credit score in the next couple of months in order to get a mortgage, finance a car, or consolidate other debt, you could hold off canceling that credit card, but don't hang on to unwanted credit cards forever. If the card is no longer serving your purposes and you would rather swap it out for a card that would better meet your current needs, you should do it. If you make on-time payments and keep your utilization low, making changes like that will not hurt you over the medium or long term. And if you are looking for a new credit card, consider shopping for one at the Yukon project. We have a marketplace with all types of cards. You can research their policies and their most recent incentives. It's a fast and easy way to look at a lot of different brands. If you have any questions or comments, post them below. We're trying to build a community of people who can share their experiences so we can all be better informed when making decisions about our personal finances. If you found this information helpful, please like this video and subscribe to our channel. Your support helps us out, and we really appreciate it. Thanks for watching.